Whether you've been trading for years, you manage millions, or you're just starting out, we all have something in common. We all make trading mistakes. Finding trading success is never a direct route, and there are many pitfalls that a trader can fall into. There are those mistakes that are really easy to fix without too much effort, but then there are those other ones that are going to be a challenge. Looking at the psychological factors that can inhibit our success, there is not a fast way to deal with them except diligence and time. Money makes people emotional, and perhaps that's one of the reasons that is often cited as a major influence on the health of a personal relationship. And if people can't quickly change their thoughts about money to save a relationship, what chance would they have when it comes to trading? When a trade goes against a trader, there can be a wide range of reactions from simply acceptance of the random distribution of wins and losses all the way to anger. And this anger will cause a trader to do things they know that they shouldn't do, such as move their protective stop away from current price, which will destroy their risk profile that was originally planned out. The same anger will have the same trader attempt to get back at the market by knee-jerking into a trade that falls outside of their trading plan. And these types of reactions, they rarely turn out well. And it's simply going to erode not only the confidence of the trader, but also erode their account balance. And the fact is that this type of reaction is hard to change. The question would be, why does the loss anger this particular trader? Were they mad at being wrong? Did they put too much pressure on themselves to make money? Have they not accepted that the only control that we really have is whether or not we trade? It's quite a process to change how we look at trading, and more often than not, this person is going to flame out and just move on. Without sound grounding and understanding how our psychological demons can affect how we trade, being a successful trader will continue to stay out of reach. And there's no easy fix to this problem, and it's often going to require a paradigm shift to, at the very least, take a bite out of its effects. And some mistakes we will come across in trading are a little easier to fix because they have more to do with taking action as opposed to how we think. And one thing you may want to consider is the following. How we think will dictate our behavior. It is our behavior that will determine our outcome in everything we do. Whatever method you're trading to make a second income or as a full-time trader, it should be covered fully in a trading plan. And this plan will have everything from risk parameters to markets to trade and setup criteria. You've done the testing, and you know you have a positive expectancy system in your hands, and you just have to follow it. If you're prone to moving your protective trading stop further away from oncoming price, you can just not do that. And this may entail using alerts at various price points to keep you from micromanaging every blip that occurs on your trading chart. And if you think the next setup is a sure thing, and you have a habit of increasing your position size outside the risk protocols that you've set, have someone else set the trade up in your platform. Perhaps you're easily influenced by other people, so you simply stay away from the tips from the Twitter traders as well as the various trading forums. There are also those mistakes that happen just because you did not pay attention. And that's what I really want to cover because it recently happened to me in a Forex position I was looking to trade. When taking longer term trades in the currency markets, I will establish the position in the retail market where I can better position size the trades. Now remember that Forex does not have a centralized exchange, so getting volume data for currency pairs, regardless of what you've read, will not be an accurate representation. For volume, I will look at the futures contract for a particular currency. So in this particular case, I was looking for USD strength over the Canadian dollar, and I wanted to initiate a position to reflect that. Now this is not day trading, which means I only have to come in after the market close to see if anything of interest is setting up. And when I refer to the close, FX is virtually 24 hours, and I will come in near the close of the stock exchange for consistency. So let's break down all aspects of this trade, and you will easily see the trading mistake I made, and it falls right into the easily fixed category. For the longer term trend, we're going to look at a weekly chart. So we've been in an overall downtrend for a few years, but this rally is the largest in distance than the last big complex correction that was back in 2011 to September of 2012. And I've shown the symmetry movement of the last big correction with the red horizontal line shown with number 1. Now from a structural point of view, taking out the high at number 2 has put the downtrend in danger. However, the high at number 3 that was sold with higher volume was followed by, at this point in the chart, a lower high. On this chart, we have not put in a higher low, so from a basic trend structure standpoint, shorts are still the play. A higher low would have been made if price had taken out the high at number 3. And this pullback off the new high can't be considered a success at this point, and it had failed. 3 possibilities now for me to consider. Number 1 is a complex correction is forming. Number 2, a trend resumption to the downside. Number 3, the consolidation is forming. And if you want to use an indicator for trend, the 200 SMA for a quick visual aid is riding above price as well. Now the trading time frame is the daily chart. A large run-up in price has occurred, which means Canadian dollar strength. And after the sell-off, price put in support at number 1. The red lines mark number 2, shows that price is making lower highs, showing that the bears are selling at lower prices, even though price is holding the support. And this is a bearish price pattern, but we are in a consolidation. My play was looking for a break at the support with volume and then flipping to the USD Canadian dollar FX chart and buy stopping the high. You can see that the volume in the break was weak in comparison to previous volume, and it is lower than the average of the last 30 days of volume. There was a lack of interest in this breakout from those who matter, and therefore I should have sat on my hands. The day before saw higher than average volume as price rode into the support zone without a clean break, and that tells another story. I made a huge trading mistake, and that was that I did not fully implement the plan that I had for the trading setup. This is the daily Forex chart. We have a bullish price pattern taking place on this chart as the bulls are interested in higher prices, even though there's resistance above shown at number 1. Price does not break out to the upside, and using the RSI at number 2, you can see that we have not even hit an overbought condition. While centralized volume is not available for Forex, I'd be happy with price leaving oversold during the breakout or being in an overbought condition. And we have neither on this chart. And while I did see price hugging the top side of the zone, there was very little conviction in the hold as seen by the candles. The second day was where I entered the trade using a stop order, and there was zero traction in the trade. Now, one mistake I do not make, but many do, is forgetting or just ignoring placing a stop. Every trade has a stop entered upon entry, and the stop for this trade was 2 times the ATR, and it was taken out. Now, the mistake I made was really easy to fix. Follow the trading plan. And although I did trade with the longer-term trend and understood the current conditions, I failed to validate the breakout with strength. If I were diligent in following the plan, I would not have entered this trade as the conditions to put the probabilities in my favor were not present. And if we were to classify trading mistakes, this is not an account-ending error. I used proper risk protocols, and this trade was planned. It was not a knee-jerk entry to make back a loss where I knew it was a sure thing. This error could have been a lot worse if I made the mistake of not following one of the most important rules, and that is watch your risk. And as traders, we want to look at ourselves as risk managers first. In doing so, I set a volatility-based stop, and I risked a safe portion of my trading account. But I did not confirm the trade, and I really have no excuse as to why I didn't. And this is the reality. Now, slick marketers, they're going to try to sell you all the glitz behind trading. Rarely will they show you losses, and especially where they've made mistakes in their trading. And they're going to make you think it's an easy process. You find your setups, you place your trades, you reap the profits. It's never that easy, and most times you will contend with other factors and not just the 1, 2, 3 path to riches. And the point is that mistakes will happen, and the severity will depend on what side of the line it falls on. Throwing risk protocols out the window or letting your emotions dictate your actions is something to avoid at all costs. Now, my mistake, it's an easy fix. Ensure I follow all aspects of the trading plan so these errors do not cost me in the future. And if I'm going to lose a trade, I want to lose it by doing things right. So you got to ensure that you're taking your trading mistakes seriously. Immediately act to get a handle on the mistakes, especially if they are causing you to constantly ignore a more professional standard of trading. Now, there are many things that we cannot control in trading. Now, the ones that we can control, like simple trading mistakes, we'd be really smart to take measures to reduce them happening in the future.